Good day, all. Ira Epstein of Linn Associates with your agricultural wrap-up for this Wednesday, May 8th, 2019. Remember, tomorrow, an important day, the Chinese delegation comes in, and then either something is done quickly or tariff wars begin at just after midnight on Thursday. Now, before I get into my review, I already know I'm not going to be in the office tomorrow afternoon. That's Thursday on the 9th. So there'll be no reviews tomorrow night for these videos. They'll resume on Friday. I've got to take care of something personal. All right, so let's talk about what this all means. You know, the marketplace is getting itself ready in every sector now. People have adjusted to what they think might or might not happen. Will we see releases during the day as to how the meetings are going? Probably not. They seem to be very tight-lipped as they take place, and nobody tells the truth anyways until we know where we're at. We saw that with the Chinese sending in the draft this weekend that started this whole explosion because they backtracked on everything. Will agriculture get a bounce because of it? I don't know. Will bonds and notes continue with the safe haven bids they have this week? It's your guess is as good as anybody else's. But when we look at soybeans, here's what we do know. So far, the farmer's taken a brunt of selling. You've recently gone from $9.25 and a quarter, beginning at the beginning of this year, down $1 a bushel to $8.14 and a quarter, and we're pushing on the low close that we had back here in July of last year. Will the market accelerate from that? Your guess as good as anyone else's, because it's not about the chart action right now. It's about the deal. We had an attempt yesterday that did not do well in trying to fill the gap that we've left in the market. So now the question is, what does the market do here? Does it trade in this range, try to fill that gap? If something bad were to happen and you were to gap under the low right here, and that low of this day, by the way, is 8.16 and a quarter. And you're far away from that. That'd be a big gap. Something would have to happen. Traders would call that, first of all, a breakaway, then a runaway gap. I am not expecting that. But it's a chart term you should be aware of. When you look at what's going on, you can see that you've had, since way here at the beginning of April, the sideways pattern, and then the market broke down. I don't think many people thought it was going to drop from 9.10 down to almost 8.10 in that short period of time, but that's exactly what's occurred. When we take a look at moving averages, even if this market were to get a hard rally, the 868 level right now turns out to be a resistance point. That's about 40 cents higher. You'd have to take out 836 and a quarter to break the pattern of lower highs, lower lows. That's about 9 cents higher right now. What the market had been doing is running the lower Bollinger Band, which is very typical, especially if you get an embedded reading in a market. So what we have is momentum is still locked in bearish. The market has gone into a pause, as many markets will as we get into this important time frame with the U.S.-Chinese trade deal. And where you go from here, well, that's the big question. Are we in a market that can snap back because it's dropped so much? Of course you are. Don't get away from that. But keep your eye on momentum. It's your friend, and it'll tell you what's going on. Should you lose it and the market close over a 20 reading, it's probably a sign that things are going well in the trade talks. If you stay embedded, it's probably a sign that they're not. In the meal market, it's the same pattern. You've got lower highs, lower lows. You're running the lower Bollinger Band with the embedded reading. Still a very bearish situation. Soybean oil. Well, the question in soy oil, because it's the end of the tail. In other words, you're whipping around beans and meal, and the real demand factor isn't soy oil. It's going to be the meal. The question is, does the market keep its embedded reading? Same thing as the other markets, lower highs, lower lows, quite bearish. The corn market is going sideways now in a pattern that's unusual. You've got the lower highs, lower lows. The market came today, fought a battle, and closed just underneath the 18-day average. So who's got the trend? The bears. Lower highs, lower lows, bias down. Now the question is, does momentum turn down? To turn this around, you've got to get the market over 368 and a quarter. That would give you, and I'm assuming you don't go down to 355 and a half first, higher lows, higher highs, and put into play the upper Bollinger Band potentially. But right now, the bears are doing their job of holding this market in check. When we go to Chicago wheat, The high today, 443.5. What is the 18-day average? 443.5. You rallied right up to that number and you stopped. Now, what we were looking for, and I had said it to you yesterday, you had missed getting to that number on this day when we lost the embedded reading. You missed it by a penny. And I said, it's close. Is it close enough? I don't formally think so. And I know I said that yesterday. At least I think I did. And today you hit it. So you're up to the area where the market's got some resistance. In the sugar market, just continues to sink with the embedded reading again, the market running the band until you lose this reading. The rallies in these markets away from the Bollinger Bands are still, in my opinion, getting sold by the pros. In the cotton market, not quite the same picture. You've got a higher high, lower low. I don't define that as a trend. Certainly, none of us are blind. We can see how prices are coming down. But what the market did back here is it got back to the 18-day average and put it back into that sideways zone, and now it's trying to accelerate again. But you're very oversold. You're running the past 3 days the lower Bollinger Band and not really adding materially to any downside just yet. Is cotton vulnerable if the U.S. trade deal goes sour? Probably. Cocoa market. Lower highs, lower lows. Yesterday I pointed out that the market had sliced through that 100-day average, but now the question is on a rally back, would that act as some resistance? And that's what it did today. So it's the combination of this and the 18-day average. But who's got control? The bears. You've got lower highs, lower lows. The bias is down because you've closed under the 18-day average of closes, and momentum is still pointing down and not oversold. Yeah, you could stall at that 100-day, but if you start breaking down, you put into play again the possibility of getting to that lower Bollinger Band. In the cotton market, from the sideways action up here, this market just fell apart. Obviously, trade has a lot to do with it, fear, how our world economy is doing, and you break hard, you rallied back to the Bollinger Band, and then you seem to be dropping under it, and now you're getting that embedded reading. It all adds to bearishness, but you know, and I've got to say this, get a U.S.-Chinese trade deal done, everything can explode in your face the opposite way that it's been going. You don't know. I mean, if you know what they're going to do in those trade talks, great for you. I don't. Cattle, lower highs, lower lows. You know the one thing I keep hearing? Everybody's talking meat's going to be in big demand, and because of what China, with the culling of the African swine fever and the hog population, they need more. And I saw today, they do. In fact, they've been buying from Brazil an awful lot of pork. It went up rather dramatically, but not our stuff. And that's your sinking away in beef. You can see that in both feeder cattle and fat. And the hog market still hasn't picked up. Again, this can all change on a dime with the trade deal. Even though I won't be doing my videos in the afternoon tomorrow, my morning subscriber video I'm doing. Now, we put a new feature in it. Right now, how it works, and the video looks like this, and what I do is I record 40 charts on futures, 5 on ETFs. But I know that a lot of people would like to just get to the selection that they want. So what we're putting on, and with help tonight, I think it'll be ready in the morning, is not only do I cover the markets in this way, but when you move your cursor over the bottom, what's going to happen is it'll take you to this section so you can just hit it. It'll take you right there on the video, and away you go. I know for a lot of people that's going to be a big edge. Remember, in my morning video, unlike these that I can only talk generically what I'm seeing in a trend, I can give specific chart action. I can tell you what I think the pros are doing, where they're doing it. I will cover in the morning the technicals at that point in big detail, and I can throw out very specific trade ideas. So if you're the kind of person that's saying, I have this idea, I wish I had somebody I could bounce it off of, that's the whole idea of this video. The video isn't there where I'm acting as a broker per se. I'm the guy that's showing you what he's seeing, using more tools than you see here, why I'm using them, and where the market's, where I think it's at least going to head, and why. How do you get access? Well, it is a subscriber video. The first 20 the first 30-day access is $7.95, which is 26.5 cents a day. No contract. If you want to continue, that's great. If you don't, that's fine. If you continue, it's $15 every 30 days after that, or you can take out a 1-year subscription for $156. Your choice on how you'd want to work it. The one thing that I'll tell you, in markets like this, to risk 26.5 cents to see if I'm worth you doing that, I'll let you be the decision maker. I'm Ira Epstein. I will see you all Friday. Remember that. Take care.